Hello, fellow Rebel Capitalists. Hope you're well. More banking news. Credit Suisse, their credit default swaps are exploding in price, which means the market is betting that they may be next to go bust. Maybe the banking risk isn't just with these small and mid-sized banks. Let's get into this article from Zero Hedge and check it out here. Let's see. We got the screen. Dang it. I just turned the screen share off, not on. All right. There we go. Let's get into this article. Title: Credit Suisse credit default swaps hits record highs. That's as of this morning, about an hour and a half ago, as Silicon Valley banking crisis spreads to Europe. Now, we know that, and I'll probably do another story on this later, that HSBC purchased Silicon Valley Bank in their branch in the UK, or their banking operations. They purchased it over the weekend for $1. They probably overpaid. But we'll have to address that in a separate video. But just for those of you who might be new to the channel, credit default swap is just simply insurance. So if the price of the insurance that on Credit Suisse is skyrocketing in price, that means that more and more people want to buy insurance, or more and more people are betting that Credit Suisse is going to go bust. And that's why they're buying this insurance. And the more and more people that are betting on it, obviously the higher the demand goes, the higher the price. So the price of a credit default swap is basically a proxy for the market probabilities, or the probabilities that the market is attaching to XYZ entity going belly up. Let's get into the article. There's shares of European banks plunged on Monday. Yields on European bonds dropped on the implosion of Silicon Valley Bank could force central banks across Western world to either slow the pace of interest rate hikes or to actually do a pivot. And we're going to do another story on this as well. I think Josh will tell me a lot of you in the chat have been asking why on earth the stock market's going up with all this bad news. Because bad news is good news, remember? That's the topsy-turvy, upside-down, bizarro world that we live in right now. So because we have all this bad news, and because the global monetary system might collapse, because we have all this risk off that, or this additional risk that is being seen in the yield on the 2-year Treasury going down by 100 basis points, something we haven't seen it since 1987. The market digests this and says, oh, wait a minute. The world is coming to an end, but that means the Fed is going to lower interest rates. Oh my gosh. Buy Cathie Wood, buy Bitcoin, buy Zoom, buy Tesla, buy whatever else she owns. Risk on, risk on, risk on. So you've got risk off and risk on all at the same time. And that's how insane markets are right now. But for those of you who are wondering why the stock market's going up, that's what's happening. They're predicting, because of all this bad news, the Fed is going to pivot sooner than later. But we're going to do another story on that entirely, along with Jeff Gundlach saying that because of what's happening in the yield curves, recession is now imminent. Just a little teaser there. Let's get right back into the Zero Hedge article. Credit Suisse Group is one bank that caught our attention this morning. So this is, I believe, their share price that is getting very, very close to zero. But they plunged 15% to a new record low. Talk about their share price. And this would make sense when you look at what their credit default swaps are doing. So the selling pressure on Credit Suisse is basically they're attributing that to Silicon Valley Bank, sparking a crisis in confidence. Right. But see, I listened to Jeff Snyder's most recent podcast this morning, which I highly suggest. I was at the gym, and I don't know that this is just with the banks here. I think that we could just be seeing the expression of the lack of confidence in the global monetary system. Uh, we could be seeing the market expressing their lack of confidence in the global monetary system through the share price and the credit default swap price of Credit Suisse. I think that's the best way to say it. It might not just be an issue. We could be looking at the micro here, where we've really got to zoom out and say, wait a minute, maybe we're just seeing the cracks in the system, but we've got to look underneath the surface to realize that the real problem isn't just the banks. The real problem is potentially the global monetary system having another, tectonic plate shift that causes this massive 9.0 earthquake like we saw in 2008, 2020, or, maybe 1987. So here's the price of their credit default swaps, and they're pointing out that they're at an all-time high today. And they say it's not just credit default, it's credit default. It's not just Credit Suisse, it's the whole financial sector where they're, my goodness, look at that chart. Wow. Talk about parabolic. Holy goodness gracious. And this isn't just European banks. You got Goldman Sachs in there. You got Bank of America. Wow. And, normally I would say this is panic, and it could be an opportunity. If you guys watched the first live stream of the day, that's what I was talking about. I was telling my personal story about me at the gym thinking, hey, maybe I could get some of these banks on the cheap. But when the bond market and the derivatives market is saying this, that's when I'm like, okay, this is the smart money that's way smarter than I am. This isn't just, millennials and Gen Zers going in on some YOLO trade with GameStop or Dogecoin. That's not what this is here. This is an entirely different ball game. These are the guys and gals that know. These are the Zoltan Pozars, right? These are the Jeff Snyders. And so when they're making these bets, that's when I think you got to be humble and be like, whoa, time out here. What are they trying to tell me? What are these prices trying to tell me? And I think they could be trying to tell you not just that the banks are in trouble, but there's something much, much, much bigger at play here. And that's what the whole bond market, the yield curve, has been trying to scream at us, not just tell us, but it's been screaming at us for the last 9 months or a year. And I'm not claiming that I know what the true problem is. I'm just making some comments and giving you my analysis here that I think there's something going on that's far more potentially, catastrophic. I hate to use that word, but I don't think that's hyperbole. That there's something far more catastrophic that's happening here behind the scenes. Let's go back to this Zero Hedge article. So we know about the regional banks being under pressure. And, something I was talking about on the live streams last night when I was doing the public live stream is the fact that I was so infuriated. I was so angry at even the potential of them bailing out these banks. Why? Because this is just one step closer to a central bank digital currency. And I think we'll probably save that for another video. But, what they're saying is that no depositor should ever lose money. Okay, so let's just take FDIC from 250 up to infinity and beyond. Let's just take FDIC Buzz Lightyear. Okay, well, if we're taking FDIC Buzz Lightyear, what's the next step? Well, why on earth do we have any of these deposits on a bank's balance sheet that could actually go bust? Remember, there's one bank that can't go bust, the Federal Reserve. So why don't we just take all these deposit liabilities and just move them to the Fed? Problem solved. I can almost guarantee you that we're going to start hearing this rhetoric and this narrative by the central planners and the authoritarians throughout the rest of 2023, especially if these banking issues get worse. All right, guys, enjoy the rest of your afternoon. As always, make sure that you're standing up for freedom, liberty, free market capitalism. See you in the next video.